The day. The markets went silent. At exactly 8:17 a.m., Daniel watched $32,000 disappear from his portfolio. Not physically, of course. No cash floated out of his apartment window. No alarms rang. No banker called him. Just numbers. Red numbers. Violent red numbers. The kind that make your chest tighten even when you promised yourself you were a long-term investor. But inside Daniel's apartment, the emotional climate had changed completely. His phone buzzed endlessly. "Bro, are you seeing the market? Is this another crash? Should we sell? Bitcoin is collapsing. Banks are getting destroyed. People are saying recession." He refreshed his brokerage app again. Another drop. The S&P 500 had entered panic territory overnight. Tech stocks were falling aggressively. Crypto markets were bleeding. Financial influencers on social media had transformed from motivational prophets into emergency broadcasters within hours. And Daniel felt the most dangerous emotion an investor can feel during uncertainty: urgency. The overwhelming urge to act immediately. Sell something, move to cash, buy gold, short the market, do anything except sit still. Because human beings are psychologically uncomfortable with uncertainty, and markets manufacture uncertainty professionally. 5 years earlier, Daniel knew almost nothing about investing. At 26, he worked remotely for a logistics company and quietly feared becoming financially irrelevant. He never said that sentence out loud, but he felt it constantly. Everywhere he looked online, people seemed ahead. YouTubers in expensive apartments discussed financial freedom. Crypto traders posted screenshots of overnight profits. Twitter investors spoke about making your money work for you. Teenagers online used words like dividends ETFs, compounding asset allocation leverage. Meanwhile, Daniel still transferred money manually between accounts, hoping his salary lasted until month end. The gap between his financial reality and the internet's financial fantasy slowly became psychologically painful. And pain changes behavior. That was the beginning. Not greed, not ambition, emotional discomfort. Most people don't enter investing because they love finance. They enter because they fear financial vulnerability. That fear becomes the gateway. Daniel's first investment was terrible. Then a cryptocurrency someone described online as the next Bitcoin. He bought without understanding. Tokenomics, liquidity, risk exposure, market cycles, volatility. He bought emotion. And for 2 weeks, it worked. The price exploded upward. Daniel checked his portfolio every 20 minutes. His brain flooded with dopamine repeatedly. He began calculating fantasy futures, early retirement, luxury apartments, financial independence, quitting his job. The investment world started feeling magical, predictable, easy. But markets are dangerous precisely because they reward bad behavior temporarily. The coin crashed 43% in 3 days. Daniel panicked instantly. He sold near the bottom, then watched it recover partially the following week. But that experience introduced him to one of the cruelest realities in investing. People often buy emotionally near tops and sell emotionally near bottoms. Not because they are unintelligent, because fear and greed chemically distort perception. Over the next year, Daniel consumed financial content obsessively. Every night, podcasts, investing videos, stock analysis, economic predictions, market commentary. But something strange happened. The more information he consumed, the more anxious he became. Every expert sounded certain. Every prediction sounded urgent. Every thumbnail implied catastrophe or opportunity. This changes everything. The next market crash. Why smart money is leaving. Buy this before it explodes. And Daniel became addicted to it, not intentionally, neurologically, because uncertainty creates attention fixation. And the brain desperately seeks information when outcomes feel unstable. That is why during crises people refresh. Stock apps, news feeds, Twitter, YouTube portfolio trackers, repeatedly. The mind mistakenly believes more information equals more control, but emotionally overloaded investors often become worse decision makers, not better ones. One evening, Daniel visited his grandfather, an old, quiet man who rarely discussed money unless asked directly. His grandfather had lived through currency devaluations, recessions, political instability, banking crises, inflation shocks. He had seen entire economic cycles come and go. Daniel expected sophisticated investment advice. Instead, his grandfather asked one question. "Why are you investing?" Daniel answered quickly. "To build wealth." His grandfather nodded slowly, then asked, "No. Why emotionally?" Daniel laughed awkwardly. But the old man continued staring at him calmly. The silence became uncomfortable. Finally, Daniel admitted, "I think I'm scared of being left behind." His grandfather smiled slightly. "Good. Now you're finally being honest." That sentence stayed with him for years, because most financial behavior is emotional before it is rational. People say, "I want wealth," but often mean, "I want safety. I want freedom. I want status. I want certainty. I want relief." Money becomes psychologically symbolic, and symbolic things trigger emotional behavior. Then came the crash, a real one, not a temporary dip people joked about online, a genuine fear-driven market collapse. Banks failed overseas, inflation surged globally, layoffs spread through tech companies, markets entered sustained volatility. And this time nobody sounded confident anymore. Not analysts, not influencers, not economists. Fear had replaced certainty, and fear spread socially faster than almost anything else. Daniel watched people transform psychologically within days. Friends who once preached long-term investing suddenly wanted out immediately. People who mocked conservative investors began hoarding cash. Speculators became survivalists overnight. It was fascinating and terrifying. Because Daniel realized markets are not just financial systems. They are emotional ecosystems. Human emotion moves through markets like weather: optimism, euphoria, denial, fear, panic, relief, over and over, generation after generation. One night, unable to sleep, Daniel studied historical crashes for nearly 6 hours. He expected different causes, different mechanics, different economic structures. Instead, he discovered the same emotional patterns repeated endlessly: the dot-com bubble, the housing crisis, the pandemic crash, currency collapses, debt crises, different assets, same psychology. Human beings repeatedly overestimate certainty during booms, underestimate risk during optimism, panic during volatility, seek emotional safety during declines. The technology changes. Human behavior barely does. That realization changed how Daniel saw investing forever. He stopped chasing predictions, stopped trying to become a market genius. Instead, he became obsessed with resilience. That word became central to his philosophy. Not maximum gains. Resilience. The ability to survive uncertainty emotionally and financially. He rebuilt his life methodically. First, he created an emergency fund, and then reduced unnecessary debt, then built diversified exposure, then limited speculative positions, then created investing rules specifically designed to protect him from himself. Rules like never panic sell during volatility, never invest based on social media excitement, never confuse luck with skill, never check portfolios obsessively during crashes, never invest money needed emotionally. The final rule mattered most, because money tied to emotional survival creates irrational behavior automatically. Months passed. Markets remained unstable, but Daniel slowly became calmer, not because uncertainty disappeared, because his dependence on certainty weakened. That distinction matters enormously. Most people think confidence comes from predicting the future accurately. Real confidence often comes from surviving uncertainty repeatedly. And then another shock arrived. Global energy prices exploded upward. Inflation worsened. Media fear intensified again. This time, Daniel observed something incredible. His emotional reactions had changed. Earlier versions of himself would have panic, watched markets doom, scrolled financial news, sold impulsively, searched for certainty everywhere. Now he simply reviewed his system, allocation percentages, cash reserves, risk exposure, time horizon. The crisis still mattered, but emotionally, he was no longer drowning inside it. And that is one of the most important transitions an investor can ever make. From emotional participant to disciplined observer. One afternoon, Daniel met an old university friend named Charles. Charles had made enormous profits during a speculative bull market. Luxury watches, aggressive trading, constant leverage. A huge social media confidence, but the downturn had destroyed him psychologically, not just financially, emotionally. Charles checked markets compulsively, couldn't sleep properly, became irritable constantly. At one point, he admitted quietly, "I think I tied my self-worth to my portfolio." Daniel understood immediately. Because modern investing culture encourages identity fusion with financial performance. When markets rise, people feel intelligent. When markets fall, people feel personally diminished. That is emotionally dangerous, because markets fluctuate constantly. If your identity fluctuates with them, psychological stability becomes impossible. Years passed. Daniel's portfolio grew steadily, not explosively, steadily. And strangely, that became more satisfying. He no longer fantasized about overnight wealth. He valued stability, optionality, emotional control, long-term compounding, strategic patience. Things younger investors often underestimate because they appear boring. But boring financial behavior compounds magnificently over decades. That is one of investing's strangest truths. Excitement and profitability are often inversely correlated. Meanwhile, the online financial world became louder than ever. New crises emerged constantly, new predictions, new fear cycles, new opportunities, new guaranteed wealth systems. Daniel noticed something fascinating. The people constantly reacting emotionally to markets rarely built durable wealth. The calm investors did. Not because they were always smarter, because they stayed functional during volatility. That matters more than most people realize. A mathematically excellent strategy becomes useless if fear prevents execution. Behavioral consistency beats intellectual inconsistency over long periods. Every time. One evening, Daniel sat alone on his balcony during heavy rainfall. The city lights blurred softly through water streaks. He thought about the younger version of himself, the anxious man refreshing portfolios every 15 minutes, the man desperate for certainty, the man who thought investing was about prediction. He smiled quietly, because now he understood something deeper. Markets are mirrors. They expose impatience, ego, greed, insecurity, fear, envy, impulsiveness. Wealth building is not merely financial. It is psychological refinement under uncertainty. And most people never realize this because they spend years studying markets while avoiding studying themselves. The next morning, another red day hit global markets. Social media panicked again. Financial influencers uploaded emergency videos again. Predictions spread again. Fear circulated again. Daniel made coffee slowly, opened his portfolio once, reviewed his allocations, then closed the app calmly. Because after years inside financial chaos, he finally understood the truth most investors learn too late. The market will always try to provoke emotion before it rewards discipline. And those who master themselves often outperform those trying desperately to master the market. Not because they can predict the future, but because they remain rational when rationality becomes rare. If you found this valuable, subscribe. Sterling Invest offers more deep-dive finance documentaries on investing psychology, economic resilience, and long-term wealth strategy. And in the comments, What do you believe is the biggest threat to modern portfolios right now? Inflation, debt, market bubbles, AI disruption, geopolitical instability? I'd genuinely like to hear your perspective.